What's up, future CPAs, and welcome to this explainer. Look, if you're a BS accountancy student here in the Philippines, you already know the ultimate struggle. You learn these insanely complex taxation concepts in your second or third year, right? But somehow, you're expected to retain all of it until you finally sit for the LECPA. Honestly, rote memorization just is not going to cut it for a 3-year gap. So today, we're actually going to use brain hacking study techniques to guarantee your long-term retention of estate tax deductions. We're zeroing in specifically on ordinary deductions, and we're going to build this mental, analytical framework that literally makes these rules impossible to forget.
So here's our cognitive roadmap for today. First, unpacking LITE and TPU. Then, losses and the ShIFTERS hack. Third, indebtedness and the AVENGERS criteria. Fourth, decoding CAIP and mortgages. Fifth, unpaid taxes in public use. And finally, a rapid-fire LECPA review.
All right, let's jump straight into Section 1, Unpacking LITE and TPU.
Okay, so in cognitive psychology, there's this super effective concept called chunking. It's basically where you group random messy pieces of information into a single memorable unit. For the boards, LITE and TPU are your ultimate chunking tools. Whenever an estate tax problem asks you for ordinary deductions, I want your brain to instantly flash the word LITE. That stands for losses, indebtedness, which are claims against the estate, taxes, claims against insolvent persons, which we just call CIAP, and unpaid mortgages. Add TPU to that, which stands for transfers for public use, and boom, you've already built the foundational architecture you need to solve the problem. Now let's unpack each of these buckets.
Moving right along to Section 2, Losses, and our ShIFTERS hack.
I want you to pause for just a second here. Try to force your brain to actually guess the valid causes of deductible casualty losses before we reveal the answer. This is called active recall, forcing your brain to struggle a bit to search for the answer. It strengthens your neural pathways way better than just passively reading a textbook. Okay, got your guesses? Let's see how you did.
The tax code actually gives us a very specific, inflexible list of allowable casualty losses. And since human brains remember weird words and patterns way better than dense legal jargon, let's burn this mnemonic into your memory right now. Think ShIFTERS. S for shipwreck, F for fire, T for theft, E for embezzlement, R for robbery, and S for storms. So if a board problem tries to trick you with a loss from, say, a plummeting stock market, does that fit ShIFTERS? Nope, not at all. So it's absolutely not deductible.
But wait, just having a ShIFTERS loss isn't quite enough. It has to meet 3 strict requisites, and these are the exact traps examiners love to set for you. First up is timing. The loss must happen during the settlement of the estate, and strictly not later than the last day for the payment of the estate tax, which is generally within 1 year of death. Second is the compensation rule. The loss absolutely cannot be compensated by insurance. I mean, think about it. If an insurance company already paid for the fire damage, the estate didn't actually suffer a real financial loss, right? And third, the tax treatment. You cannot claim this exact same loss as a deduction for income tax purposes. Absolutely no double dipping allowed.
All right, let's lock this in with a rapid-fire bullet review. Say it with me. Deductible losses must be ShIFTERS, occur within 1 year, remain totally uncompensated by insurance, and not be claimed for income tax. Perfect.
Okay, Section 3, Indebtedness. Avengers assemble.
So here's a crucial reality check. Examiners are never just going to hand you a perfectly valid debt and say, here, deduct this. They are going to test your ability to spot a fake. People in the real world might try to invent completely delulu claims against an estate just to reduce the net taxable estate and pay less tax. So how do you, as the brilliant future CPA, audit this claim? You have to apply the AVENGERS criteria. You basically run the debt through this gauntlet and check off every single letter. The debt must be for adequate and full consideration. It's got to be valid and legally enforceable in court. It must not be condoned or forgiven by the creditor. It must be contracted in good faith. It has to be existing at the exact time of death. It must fall within the reglementary period, meaning the legal right to collect hasn't expired. And finally, it must be perfectly substantiated. Listen to me on this. If a debt fails even one of these AVENGERS checks, it is completely eliminated as a deduction. Toss it out.
Now, if the debt is specifically a loan, watch out, because the rules get even stricter. First, the debt instrument must be notarized at the time the indebtedness was incurred. Not later, right then. And here is a classic board exam detail.
If the decedent borrowed that money within 3 years prior to their death, the executor must submit a sworn statement showing exactly where the proceeds of that loan went. This is to prove the loan wasn't just some paper fiction created right before death to dodge taxes.
Here is your bullet review for indebtedness. Channel your inner avenger. Prove the debt is real, verify the notarization, and if it's a recent loan within 3 years, substantiate where those loan proceeds went. Internalize this, and let's conquer the next level.
Next up, Section 4, Decoding CAIP and Mortgages.
Active recall time again. Imagine this scenario. Someone owes the decedent 1,000,000 pesos, but that debtor is completely broke. They are totally ghosting their financial obligations. What is the absolute first step you must take in computing the estate tax?
Okay, step 1 is the ultimate board trap, so pay attention. First, you absolutely must include the full receivable, the entire 1,000,000 pesos in the gross estate. Why? Because the decedent still legally owned that right to collect at the exact moment of death. Second, only after you include it can you apply the preference of credits to figure out what the debtor can actually pay. Finally, in step 3, you take the uncollectible portion and claim it as your CAIP deduction.
And you know what? Unpaid mortgages follow that exact same analytical framework. If the decedent leaves behind a house worth 10,000,000 pesos, but there's a 3,000,000 peso unpaid mortgage on it, you do not just put 7,000,000 in the gross estate. No, you include the full undiminished fair market value of 10,000,000 in the gross estate. Then, you deduct the 3,000,000 unpaid mortgage as your ordinary deduction.
Let's lock this analytical pattern into your brain for the next 3 years. Inclusion precedes deduction. Every single time. If it's not in the gross estate first, it absolutely cannot be an ordinary deduction under CAITPU or unpaid mortgages.
All right, Section 5, Unpaid Taxes and Public Use. We are almost at the finish line.
For unpaid taxes, timing is literally everything. You can only deduct taxes that accrued before the decedent's death. This means income tax on money earned before they died, or property taxes that accrued prior to death. But any income tax on income received after death, not deductible. Property taxes accruing after death, not deductible. And the ultimate golden rule, the estate tax itself is never deductible.
Finally, let's unpack TPU, Transfers for Public Use. The rule here is incredibly strict. To qualify as a deduction, the bequest or legacy must go straight to the government of the Philippines or any of its political subdivisions, like a municipality or a barangay. And furthermore, the transfer must be exclusively for public purposes. So giving land to the local government to build a public school, that is a perfect TPU deduction.
Here's your bullet review for this section. Burn these keywords in right now. Only pre-death taxes are deductible, and only exclusively public government transfers make the TPU cut.
And finally, Section 6, our final LECPA bullet review. Let's test that retention.
You've built the framework, now force the active recall. Seriously, look away from the screen right now. Can you unpack LITE? Can you list the shifters? Can you verify a debt using AVENGERS? If you can, you are officially building that 3-year-long long-term retention. But I want to leave you with this. If you can't recall these frameworks after just 10 minutes, what other passive study habits are secretly sabotaging your LECPA dreams? Rethink how you study, protect your attention, and I'll see you in the next explainer. Keep grinding.